Hi, this is Randy Finney with Right Side of the Chart, and today is Monday, May 14th, 2018. In this video, I wanted to take a look at bonds. I've spent the better part of the morning looking over various bond funds, certain different interest rates. So we'll get into bonds here in a second. Before I do that, and before you stop this video, if you're not a bond trader, bonds bore you, put you to sleep. I know most swing traders, active traders prefer stocks and ETFs because there's a lot more volatility there. And bonds, are typically steady Eddie dividend paying things. But I'm doing this video for a couple reasons. Number one, for potential trading opportunity, whether you're a swing trader or particularly a long-term trader or investor looking to either profit, maybe you're looking for income, you're an income investor, maybe you are looking to diversify your portfolio, which I'm big on. Whether you're a swing trader or a long-term investor, asset allocation is one of the most important factors in determining your returns overall. So I've talked on it quite a bit in the past. Asset allocation just means having a portfolio of different asset classes, stocks, bonds, commodities. Within stocks, what type of sectors are you going to diversify among different sectors, not just put it all in tech stocks. So bonds or asset allocation and diversification in general is a way to enhance returns on your portfolio while at the same time bringing down the risk, those big swings or the potential for loss if you're concentrated in one sector or one asset class and it goes against you. So I think there's value there for just about anybody. And then the other part is there is predictive value at times in watching the bond market, even if you are trying to gain some clues on where the stock market might be headed. For example, one of the things I watch are closely over, at pretty much any point in time are credit spreads. And that's the difference between what low grade, below investment grade, aka junk bonds, are paying and what the safe rate of return, or in other words, treasuries. So they take the difference between the treasury bond rates and the high yield. And there's various forms, there's different things we can look at on credit spreads, but it's usually junk bonds or companies, of that nature, and against treasuries. And I'll try if I can. Maybe I'll touch on that in this video. But what I look for is divergences. If you start seeing credit spreads ticking up with a rising stock market, that's often a tell that something is wrong, something is amiss under the hood. And that's where the really really smart folks on Wall Street, that's what they're looking at. If they're pricing in, if credit spreads are increasing, what that means is that typically the default risk is increasing, meaning that there might be something going on in the financial markets, maybe anticipated slowdown in the economy or something else, maybe some troubles. Rising rates can do that too. There's a lot of companies right now leveraged quite a bit that have taken advantage of this free money or low cost money in recent years to issue a lot of bonds and debt. As that debt comes due, mature, they need to roll it over. They're going to be rolling it over at higher rates because now we've gone from an environment in recent years of QE, meaning quantitative easing, to QT, which is quantitative tightening. So let's get into that. Why am I starting here with an SPY chart? Just to reiterate, the trade ideas have been light. And again, we're going to get to some trade ideas here in this video, but the bigger picture remains this: a sideways trading range since the first of the year, very volatile, a lot of ups and downs. But again, we've gone virtually nowhere. Now we're just slightly. Here's where we started the year, right about there, and you can see right now we're just barely positive for the year after going all over the place. So this is, we've had by far the bulk of the trade ideas. They're not all winners, but we've had much, I think it's been pretty consistent. We've had more, a good ratio of winners to losers so far this year. And, with all the trades on the site, the risk reward is always skewed in the favor. I like to use a 3-to-1 better RR. So even those trades that are stopped out, you're usually risking 1 unit of loss to make 3 or more units of profit. So, despite a challenging environment, it's been a good year so far. And let's just dive into the charts, and I'll go over what I'm seeing here in the charts on Treasury bonds and some other ones. We'll start with TLT, since that's a popular trading vehicle. We still have IEF, one of the Treasury bond ETFs as an official trade idea. This one was put out along with it. Since there was so much overlap, I gave targets on both and used IEF as the official trade idea. And you can see we hit those targets, and it was, a nice exit on that second target was hit, and we reversed. Now, where are we right now? And this is why I'm doing the video. I see Treasuries just recently reversed, at least TLT, and hair shy, close enough for government work. That that's a virtual tag of that support level around 116.56 or so. Pretty significant level. So if nothing else, these are levels to watch. You can see the reactions over the last couple years, quite a few reactions there. So I wanted to point out that TLT, which is the long-term Treasury bond fund ETF, it's treasuries with a 20 plus year maturity. So really, and 20 to 30 year treasuries. And you can see down here, I've noted that we have this positive divergence in place, close enough. Again, we would have had to make an equal low, so technically speaking, we reversed just a hair shy. So, if you want to split hairs, you say that's not positive divergence. But in essence, it's the same because you have your momentum indicators making considerably higher lows, both the RSI and the PPO, with prices making a roughly equal low there. So now if this continues to play out, and this is why I'm doing this video, let's watch how this could go the other way. Divergences don't always play out for a trend reversal, but more often than not, they do. As you can see here on the chart, this is, again, been shared, divergent low there, divergent high. We probably had a divergent high here. It's to the left of the chart. So now we have this positive divergence. So if this plays out, treasuries may make, and I think, the worst case scenario, there's very, relatively low volatility, low risk in treasury bonds. The biggest change in prices on treasuries, the biggest thing that affects the change in prices, I'm sorry, is interest rates. And that's because you have virtually no default risk on U.S. government treasury bonds. So interest rates going up or down, or the expectation. It's not what interest rates. Remember, the Fed does not control this. They cannot control TLT, long-term treasury bonds. They do not set the rate. They have an auction. Every time Treasury bond new issues are sold, they're sold at auction, and supply demand determines the price. After that, they trade, and as most of the bonds in this portfolio trade on the secondary market. That means people buying and selling back and forth to each other, and it is their expectations of long-term interest rates, inflation, et cetera, that control long-term rates. I just want to make that clear. The Fed does not set that. They set the discount rate and the federal funds rate, which are ultra short-term rates that banks borrow money from either the Fed directly or from each other for overnight lending purposes, things like that, and which indirectly, they're controlling really the short end of the yield curve. They try to manage this during, obviously, yes, some might argue during quantitative easing, all the bond buying. Yes, they certainly have the muscle to affect interest rates, but they cannot completely control them. So with that being said, let me get off that and let's just look at the charts. So here it is. We're at this resistance level right here. You can see, again, go to the left of the chart. You'll see quite a few reactions. Back here, capped all the advances, capped the pullbacks here. There were some reactions back here. And it was also this first target I had when we went long on it last time. So if we take out that 119.33-ish level, there's a good chance we're going to move on up again to that second target. I always set my second target, or my price targets, just below the actual resistance level, and I do that to help avoid missing a fill if something happens to reverse just shy of resistance or just shy of support. Let's say I'm short, so I cover my shorts. If that's the support level I'm targeting, I'm not going to set my buy to cover order at 116.56. I'll set it at 116.40 or something like that. Okay, so either way, potential swing trade, and there's possibility for more. Now, you might say, well, Randy, the Fed has made it clear they've been raising rates, they're going to continue to raise rates. I promise you this. What the Fed says and what the Fed does are two different things. They might have all intentions to continue to hike rates, at such and such pace, but they are reactive, not proactive. If the stock market tanks, has a big leg down, takes out those lows from January and early March, or the economy, we start to see some key economic indicators roll over and show us that the economy is slowing down or inflation starts backing off, they will back off their plan to hike rates, and therefore you'll probably see bonds go up. Keep in mind, guys, I know I'm covering there's a lot of moving parts to bonds, but remember when I'm talking about a bond ETF, the price of bonds is inverse to interest rates. So when TLT is rising, that means interest rates are falling and vice versa. So remember that bond prices and bond rates are inverse to one another. So there's TLT. That's a daily chart. I spent a lot on it, and I'm doing that because this is an actionable trade idea. There's support down here. This is a support range about 116.54 to 115 down there. Quite a few reactions there. This was a potential trend line that was recently broken, and you can see on this weekly chart as well. We were on a daily chart a minute ago. We have potential divergence. Now, a lot like the stock market with the sideways trading action. See where we're at right now. Nobody knows for sure where the next big move in the market is, and I'm referring to market participants in general. Hence the reason for this big choppy trading range we've been in. So you can see we don't have clean divergence. It looked like the PPO was poised to make a bullish crossover and the lines are flattened out. So what's going to happen now is one of two things. We're either going to get rejected and therefore not confirm that divergence, or if TLT can start moving up, then we're going to have that confirmed positive divergence. You can see we've made equal lows down here, and we'll probably come on up. Maybe we back test that line. Maybe we head up to that 128.56 level. I think it's probably the same level, or the level I just showed you before on the other charts. This is a weekly chart. There's a level right there. I meant to add just a horizontal line, not an arrow tool, but you can see that was that level I was just showing you on TLT for a minute ago. So if nothing else, I think it's a fairly low risk, especially if you can buy down here. If we happen to get another pullback to the 116.60-ish area and these divergences remain intact, what I mean by that, if we do reverse here at resistance and go down for another run there, maybe even slightly undercut the lows, that's fine. That's actually all the better if we undercut support. I've seen this in a lot of securities. I'd love to see a well-watched support level get undercut. It flushes out weak-handed longs, brings in shorts, if and only if, of course, assuming it can reverse from there. So if it did that and kept these divergences intact, in other words, we didn't take out these previous lows, that would make a nice setup. And the good thing about bonds too, remember, we still have that IEF of active long trade. You're getting paid to wait in these. They pay out monthly. These ETFs pay out monthly interest or monthly dividends from the interest on the bonds. So there's a scenario. Ideally, this is the best place to buy down here. We're at resistance now. So, TA 101 says you want to buy pullbacks to support or sell bounces to resistance, or wait for a break above resistance as well. So if we can take that level out with conviction. And another idea too is scale in. I can't tell you if we're going to, it's hard for me to tell really with these indicators flatten out whether we're going to have another thrust down or not. I just wanted to point out that intermediate term right now, bonds look bullish to me, meaning rates are probably going to go down. All right, so that's enough on TLT. Yeah, let's go to just to before we leave the long-term bonds. Now we're looking at rates. This is TYX, which is the 30-year Treasury Yield Index. So we're looking now at rates. So almost TLT in reverse, if you will. So what I see here, as you can see, I've noted here this potential divergence. We need to see a little bit of downside. There's a pretty nice, pretty well-defined trend line. So you can see TYX Treasury rates did make a double top high. We had a equal high here. So there's your negative divergence, just like we had again. We had positive divergence right here. You can see it on the RSI and the PPO. That marked this bottom. There's the divergence from this point to this point. We had negative divergence right here leading into this high. And again, these often play out for swing tradable trends. Or trend trading. Trend trading is, like swing trading, but a little bit of longer term holding periods, trying to capture the bulk of a trend. So there it is. You could have shorted treasuries. You could have went long here. So far, this divergent low has led to these highs, which have, at this point have culminated in a divergent high or negative divergence. So keep an eye on both the charts of TLT as well as TYX. I mean, they will mirror each other inversely, of course, but there's a move down. If that trend line breaks, I think at minimum we're going to hit this target zone right here. You can see it's about 29.50, maybe 29 to 29.75, and there's the potential for more, but even that would be a decent move in bonds. And one more thing, I'm throwing a lot out there too. When you trade bonds or bond funds, I often talk in every official trade that I give on the site. I make a suggested beta adjusted position size, and what I do is I look at not only the current volatility or price swings on that security, but I look at the past price swings and get an idea. And I've traded for years, and I know roughly within the what's normal, a normal trading range for bonds. And there's times you see more volatility in the bond market, just like you do in the stock market. But my point here is where I'm going with that is you can take a much larger position size in TLT or IEF, the 10-year government bond fund, than you can in QQQ or especially something like GDX, a gold mining stock. So it's not unusual if I am positioning in bonds, I'll take 150 to maybe up to 200% position size, two times what I might normally trade in SPY, because of the lower than normal volatility. Okay, just jumping out to a weekly chart to get a bigger picture on treasury yields. Again, we're on TYX 30-year treasury yields. There's that negative divergence you can see on the weekly chart here. Big divergence. I don't have all the divergences drawn out here, but you can see again they play out. These stand out clear to me. There's a big divergent low, and these are the things you look for to position for trends. And there was a nice trend there. Overbought readings as well. You can look, we were overbought here. We actually had a divergent high there as well. You can see right there. Nice little, it was actually large. That's months in the making. Now, since I'm out on a weekly chart, you can see the calendar years below. So that was about half a year or close to it. Divergent high. And again, it's simple wash, rinse, repeat. And now we're in this trading range right here. So if we fail to surmount that level, or like I said, and this is again meshes with that potential scenario on TLT I talked about. If TLT goes on to make a new low, what treasuries might pop above here real quick? Treasury yields giving us that divergent high like this, looks something like that. As long as these divergences remain intact, and then boom. So something to keep an eye on. I really think there's some value here. So I'll just say it outright right now. At most, I think there's a little upside. Before a nice drop in long-term rates, which means a rally again in TLT. And it's possible. It is possible that that top has already been put in. So I think it's from a risk-reward perspective, I think it's pretty favorable right now. Maybe consider something like a half or quarter position. Again, you may want to scale in by a little bit now, a little bit more in a few weeks, a few months, see how things play out. And then long term, this is the bigger picture. This is a long term chart. Here, let me clean up a board for you. This goes back into the 70s, you can see here. And here's interest rates. These are 30-year treasury yields again. They peaked back in 1981. So the early 80s, we began a secular bear market in interest rates. You can see it there. We had a pretty well-defined channel, but all these drops below the channel were the result of unnatural market forces. In other words, quantitative easing. You could see 2008. This is when QE began, and this sort of overrode the technicals because we had a pretty well-defined, price channel. Actually, you could draw it two different ways. I had a line like this. Gosh, I'm butchering these charts, guys. Forgive me for that. Here it is. Yeah, there's the price channel right there. So between this line and this line. But again, we're back up into the normal channel. You can see a big divergent low right here on the PPO. That's PPO histogram above there. So there's a big divergent low, and that tells us, and I think it goes without saying, that the secular bear market in interest rates is most likely over. And that doesn't mean that we're going to have to skyrocket up right away. But it does say, we know this. We got down to virtually zero interest rates, near zero rates in the U.S. We went negative rates around the world. So we know there's really not much more downside in rates. And at some point, when inflation really kicks in, we're going to start a new secular bull market in rates, which would mean a secular bear market in bonds. Sorry, I had a little interruption there in the video. I had to pause it. But I'll start to speed through these charts a little faster now. IEF, this is still an active trade. We entered this back on February 9th at 102.30. So far, it's paid out a total of 3 dividends. It pays out every month. So we've received over 52 cents in dividends. Thereby, that adjusts our cost basis down from 102.30 to 101.77. So we're slightly underwater. Even though TLT hit that target, that final target, I had some larger swing targets here on IEF, and I still like this one. That's why I wanted to, again, one of the reasons I'm doing this video. I should add a line right here. I can see there was support there. Now it's resistance. But here's the most salient point on this chart that stands out to me is this falling wedge pattern. You have a downtrend line here. I could probably tighten that up at those last reaction highs there. And you have this bullish divergence again. Now you see, like everything else, these lines are flattening out. So we're going to know soon enough. Again, we could take another thrust down. Sometimes you have what looks like a pending crossover, but the lines are rejected. And if so, just like TLT, we may need to make another thrust down, but at this point in time, that's all I think it will be, is a marginal new thrust down. We're still well above our stop. And again, the longer, even if we're locked in here for several months, we're not talking huge money. It's not paying as much as a junk bond fund or anything like that, but it's something. And again, it's just part of a piece of a pie, for asset allocation. And so there it is. So we could reverse here because we do have this potential divergence right now at that most recent low. And if we make another low, you can see that the PPO is it's still well above these previous reaction lows. So there's that potential for bullish divergence. And ultimately, if the Fed starts, so whatever happens, whatever the reason, whether it's an economic slowdown, a turn down in the market, the Fed starts backing off their planned rate hikes. Watch the bond market. The bond market's going to probably give you a better idea than the Fed. They'll give you a better idea than the Fed what's going to happen with interest rates. This is where the realm of the smart money institutions, the smartest people on Wall Street really are, mostly the ones trading the bond market, more so the mom and pops. All right, so there it is, and watch for that downtrend line, bullish falling wedge. If we break out, that'll take us easily to that first target up there. And you can see there's potential. Again, this is, I may revise like a lot of these trades, the trade ideas on the right side of the chart. If for whatever reason, as time goes on, I think that, let's say this trade is successful, it's not stopped out, and assuming it hits T1 or T2, I may call the trade in early if I think that's all we're going to get on the bounce. So like I say, the charts are dynamic and so is my analysis. But at this time, there is potential that we could, have a really nice rally in bonds if rates take another leg down. And remember, we're coming up on the longest economic expansion in history, and sooner or later, recessions are a natural part of the business cycle, and we haven't had one now for almost or over 9 years. All right, so that's that. And if we do have a recession, what that means is rates go down, meaning bond prices go up. Okay. And just real quick, that's IEF on a weekly chart, 10-year weekly chart. You can see a support zone, not super well defined, but you can see these reactions back here in 2009, 2010, reactions from above. So again, we're falling to support. And the fact that we have this big divergence as well on the weekly chart, that spans over a year, says that we could have a pretty decent rally in Treasury bonds. And if I didn't make it clear before, guys, IEF is the 7 to 10-year Treasury bonds. So these are intermediate term bonds, Treasury bonds. And then to look at those rates, you look at TNX. A minute ago, we looked at TYX, which are the 30-year bond rates. These are the 10-year bond rates. So this really, if you're trading IEF, you want to watch this chart here. You can see a nice, clean, very well-defined uptrend line. I'm sorry. You can see uptrend line right here, culminating with this divergent high that forms a bearish rising wedge pattern. There's the negative divergence down below. Just like we had positive divergence here at this low, we had negative divergence here at this high. And, that's what sparked, this end in this run right here, culminated in that divergent high, followed by a correction, which culminated in a divergent low, followed by a rally so far, which has now Um, well, we can't say terminated yet because we'll need to see, everything reversed, these divergences confirmed, and an early sign would be a break of this trend line. And as you can see, we're not too far above it. So it looks to me like that's we're setting up for a rally in bonds, which is a correction in bond rates. All right, short-term bonds, SHY. You go down to a short-term bond fund like this. This holds 1 to 3 treasury bonds. The interest rates are going to be lower, and so will the volatility. You have very little volatility because, again, government bonds have virtually no default risk involved, and so all they're trading on is interest rates. And short-term rates don't fluctuate as often as long-term rates. So there's an idea for you if you're interested in just parking your money somewhere where you might get a little bit better than a money market fund without a lot of risk. And then 5-year yields. So if you're looking at the shorter end of the yield curve as well, you can see right here negative divergence. Let me pull that down a bit. There's a divergent high right there. Here's your negative divergence on the PPO and the RSI down below. Just like we had divergence right here, led to this correction that went all the way down here into September. So that's just another look at rates there. All right, now we'll just look real quick at corporate bonds. LQD is the investment grade corporate bond ETF. You basically, corporate bonds, to keep it fairly simple, are broken down into really two categories: investment grade and junk bonds, anything below triple B rated. And so investment grade, these are companies like Apple or, companies that are doing fine. And again, they have a good investment rating. The ratings can change over time, but this fund will hold investment grade bonds. So of course, again, um, you have obviously a higher risk of default than government bonds, but a much still a relatively low risk of default overall, and so therefore these are most sensitive to changes in interest rates. So I'm looking at what looks to me like a nice clean bullish falling wedge. I see positive divergence, which is actually confirmed here in LQD. We recently had a crossover bearish cross on the PPO. That RSI is coming up to that 50 level. Sometimes that acts as resistance when tested from below, just as it acts as support when tested from above. So maybe a pullback, and again, another thrust. You'll probably see this if that scenario of one more low in IEF and TLT plays out, then you'll probably get that as well, most likely in LQD. LQD is going to pay a little bit better dividend. I don't have it in front of me. You can just check that on, go to their iShares site or Yahoo Finance, somewhere like that. So even if we do make one more low, we'll still most likely, and reverse, assuming we'll still have a divergent low. And you can see my first target up here, and these are unadjusted targets, it's actual resistance level, about 115.60, and you can see some additional targets. And I think just based on this pattern, a likely target in the coming months would be that 117.50ish area. So if you're looking for an area to target, if you want to take some profits here at 116.55, that would certainly be another area as well. But pretty bullish if we get above this 115.60. And the reason is that was a pretty well defined support level. You can see all these reactions back here, reaction here, and we just broke through it. So now this, as I'm talking, I just realized this meshes with that scenario I showed you earlier in TLT of a fake down or a false breakdown, because we did break support, and that probably washed out a lot of weak hands and longs and LQD, maybe brought in some shorts in the corporate bond market. So if we can regain that level, that's very bullish, because as I often say, fewer things in trading are more bullish than a failed breakdown, because of those reasons I just mentioned. You shake out the weak-handed longs, meaning you have the people that are going to hold only left in there. You pull in some shorts, and when those shorts realize that breakdown failed, then they have to cover. They get squeezed out, and that adds to the buying. So that's probably one of my favorite right now if you're looking for a trade on bonds. And again, a little bit more volatility than TLT. I'll just touch on MUB for those of you in a high tax bracket. This is the iShares S&P National Municipal Bond Fund. There's tons of bond fund ETFs out there. For example, if you live in California or another state with high income tax, you can go get a California bond fund. But this one looks bullish as well. You have the divergence down here, positive divergence, just like you had a divergent high right here, negative divergence at that high. which sparked the correction that we've been in, and now that's culminated in a divergent low. So again, across the board, everything I'm showing looks pretty bullish for bonds. And finally, we're going to wrap this video up with junk bonds. Again, those are your lower credit quality companies. Junk bonds, historically, junk bonds trade much more in line with the stock market than they do bonds. So, the correlation to stocks is a lot tighter. There's almost an inverse correlation between stocks and bonds, investment grade treasury bonds, but a pretty tight, fairly tight correlation normally. Now remember, since the financial crisis, things have been broken. We've never in history seen anything like the quantitative easing in the amount of it, the steps that the Federal Reserve has taken, as well as all the central banks around the world. So there have been a lot of distortions in the financial markets. What broken was the long-standing tight correlation between the stock market and commodities. That was broken a few years ago. So you're not going to see a perfect overlay, but this is a tell. Again, watch junk bonds compared to the S&P 500. If I overlay the two, let's just do that real quick. Let's show you SPY, a quick overlay. See, this is showing you some divergence here. What's happened is the stock market has been rising while junk bonds have been falling over the last almost the last year or so. So there's a little concern there. Now, where they go from here, the charts aren't that clear to me. We don't have a divergent low like we do in all the other in the investment grade instruments that I just showed you, treasuries and investment grade corporates. So we don't have the divergence that I like to look for. We do have pretty well-defined support around 35.60. We had one intraday break right there, and we look down, go to a weekly chart. You can see it seems to be, I don't have the line. I think I have it on HYG, which is the other ETF, junk bond ETF. That seems to be a level that it's pretty important right there. But either way, if you're looking for a higher yield, you could go long here. I'm not. I don't see really a trade right here. My confidence isn't high enough right now in junk bonds. I'm more so watching them for a tell on the stock market. If the market, let's say, breaks to this trading range of the upside and starts to rally, and we see junk bonds remain in this range or even head lower, what that is telling you is that the smart money is pricing in a recession. They're pricing in defaults on these bonds because the companies that have junk bonds, those low-rated bonds, are just a bad quarter or two away from defaulting on those bonds. That's what makes them junk bonds or high yielding. So when things slow down or the companies have problems, the default rates start to go up, and during a recession, the default rates skyrocket. So watch for divergence between junk or JNK or its counterpart. This is just a different company's ETF, HYG. Potential downtrend line, same. You can see the same support line there. So again, I don't see much of a trade. They kick out a decent dividend. Looks like 5.13 on HYG. So if you're looking for some yield, you can go long there with a stop somewhat below there, but I would rather just stay away from these, to be honest with you. I like these clear setups, these divergent highs. So you had a clear, nice, well-defined trend line with the divergent high. Boom, there was a great shorting up. Again, another divergent high, clear defined trend line. You had a breakdown, back test. We came up, back tested, made a marginal new high that was still a divergent high. So this was your last divergent high, and then boom, led to this correction. That's what I like to trade. I don't see much of a clear objective setup right now in HYG. Okay, guys, long video. Hope you enjoyed it. As always, when you watch these videos, increase the playback speed. If you can keep up to 1.25, 1.5, cuts the duration in half. There was a lot to cover here, and again, not just the charts. I wanted to speak to what are the differences in these bonds, what affects them, and more importantly is how we might be able to gauge where the stock market's heading if we start to see some divergence between especially these junk bonds and equities. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.